Hello, Tony. Welcome to QAV Australia, episode 821. We are recording this on the 27th of May, 2025. What have you got in your notes for today, TK?
Yeah, not much, just a pulled pork to do on ANZ, the bank.
Our old friends.
Not the whole of Australia and New Zealand, just ANZ, the bank.
Oh, that's good. Don't have time for you to do the whole country.
Yeah, 40,000 years ago, the emu dreaming sprinkled stardust on the lizard tree.
You'll start banging on about taxing super funds again, unrealised gains in super funds. By the way, shout out to anyone who was one of the 60,000 views of that video on TikTok from last week who's now listening to the show. Welcome. Thanks for joining us.
Yeah, thank you. We'll try and manufacture some other controversy for you. We'll pick something out of what we said, put it up on TikTok so everyone can have a bang on about their point of view. No, I think I've said enough about the super fund, except to say one more thing, and that is that the threshold for the extra tax and the tax on unrealised gains is not indexed. So you might think that it's only going to apply to rich people like you and I can, but without indexation, it's going to affect most people over time. So just consider that when you're drawing your battle lines for a TikTok battle on unrealised gains. Anyway, pulled pork on ANZ. I want to declare I own the stock. So that's off the bat. Have a look at their share graph today. It's currently Josephine, but it did go ex-dividend on the 13th of May. And with a bit of a long payment date until July 1st, so you should take that into account. If it does flirt with the sell line, because it is in a bit of a downtrend since it went ex-dividend, but that's what happens when these large stocks go ex-dividend. Dividend was 83 cents. And 70% franking on that. So it's worth around about $1 in round numbers. So sell price is currently $27.28, and the share price when I did the analysis this morning was $28.64. So without taking the dividend into account, it's only a bit over $1 above the sell price. Second buy line was $29.63. So if you add the dividend and the franking credit to the current price, it is flirting with the second buy line. So just be aware of that if you are considering buying it, that it is ex-dividend and we don't get paid until the 1st of July. Interesting time to talk about ANZ. It's in a bit of flux because there's a new CEO coming in, a guy called Nuno Matos, which we did report when he started a couple of weeks ago. International hire. He's already recruited his first senior exec from a bank called Santander, Spanish bank. He's coming across to be the operations manager, and I would expect there to be more international recruits into the executive ranks. So there'll be some turnover in the executive ranks of ANZ, I would expect. I thought I'd spend some time just setting the scene for what he's got on his plate immediately without worrying about what his strategy and direction is for the bank. First thing is a couple of general backdrops to banking. Interest rate cuts are happening this year, I would have thought. We've had one already, which was only 25 basis points. The RBA in their speeches when they talked about the cut thought that there would be, given all that's going on in the world with tariffs and uncertainty, that there would be more cuts during the year. So I think that should be a tailwind for Aussie banks because it's likely that interest rate cuts will spark renewed interest in the housing market, which would mean more mortgages taken out with banks like ANZ. So I suspect that he gets a tailwind behind him based on that. The other thing which I thought was interesting was a couple of reports I read in the papers recently about ANZ's use of artificial intelligence. And ANZ aren't the only bank doing this. I think all banks are probably doing it. But last week, as reported in the Fin, the chief IT officer of ANZ came out and said that his teams are creating artificial intelligence-powered agents that will initially be deployed to help bankers prepare for client meetings, lifting workforce productivity. Jared Florian, who has been Group Executive of Technology at ANZ for more than 8 years, said the rollout of AI systems that work alongside bankers on everyday tasks will be the single biggest change program the bank undertakes over the next few years. AI agents will soon be helping ANZ business bankers compile reports on companies and sectors to improve engagement during meetings, Florian said. In time, agents could be used to triage loan applications. So AI is coming, ANZ are adapting it, so that could be another tailwind for them. May not be a competitive advantage because I expect all the banks will be doing it, but it should be a boost to productivity, you would hope. So they're two sort of general background things. The other things that are going on at ANZ that are interesting to call out. One is a IT project which has been going on for a long time called the One Platform. And this is an app on your phone which is ANZ intends to migrate all customers across to over time, and then start to provide digital banking services to customers rather than the sort of clunky branch services that happen now. So ANZ report that they have reached 1 million customers on their One Platform app. That was reported on the 13th of March this year. And they also reported that they're going to make it easier for people to log in. They're going to scrap internet banking passwords in an Australian first security move. So this is a report from Channel 7 News. Internet banking for ANZ Plus customers will be rolled out in mid-2025, and that is what is set to be a password-free experience. The bank said it was the first passwordless web banking feature in Australia. Instead of a password, customers will be able to log into their accounts using a pass key, which could be their fingerprint, face, or mobile device PIN. Or customers will be able to enter their mobile phone number and approve a login request by sent to their ANZ Plus app. By introducing this change, we're helping prevent customer login details from the risk of data breaches or phishing attacks, the bank said. So
hold on a second. I just logged into my Bendigo Bank app with my face. I don't have a password on my Bendigo Bank app.
Sure you can.
That's not right.
ANZ are claiming it's a first.
ANZ are full of
Beep.
Yeah.
Had that on my Bendigo Bank app for a year or so.
Really? Wow. Okay, well, Nuno needs to take note. Go and talk to the marketing team at ANZ. However, the ANZ Plus platform has not been without its controversy. And an article in the, I think it was in the Fin, anyway, an article written by James there, so that'd be the Fin, says ANZ quizzed over risks of new platform costing $1 million a day since the project was first flagged in 2020. An app with limited functionality launched in 2022, the bank has spent $1.5 billion on the platform. It will ultimately replace that legacy ANZ technology, reducing the cost of serving customers. So that's the headline. At a briefing on Monday, which was in March 2025, ANZ Group Executive for Retail Banking, Mail Carnegie, I hope I'm pronouncing that right, Mailey Carnegie, provided no hard numbers, cost targets, or commitments on the time it will take to finish the project. She failed to rule out that costs would rise from current levels before savings are realised. Why are we in the position where you can't provide some more numbers to us? Asked Victor German, an analyst from Macquarie. Carnegie assured him returns will be realised over the medium term when more products and features are rolled out during 2026 and after millions of existing ANZ customers are migrated onto Plus over the next couple of years. Incoming Chief Executive Nuno Matos, who will replace Shane Elliott in July, would be closely involved in migration decisions, Carnegie said. A pilot for ANZ staff will begin in June. So back then they thought that the handover was happening in July. I think Nuno's already started. Carnegie said ANZ's upgrades went further than other banks. New systems will use open banking for home loan applications, while features such as introducer commissions and negotiating pricing will be rolled out next year. Plus has focused on consolidating 350 systems in the messy middle of ANZ, she said, which have now been rolled into 12 primary systems. But MST financial analyst Brian Johnson questioned whether ANZ's cost savings estimates for attracting new home loan customers were too high, given mortgage brokers still need to be paid commissions. So I think a lot of time and effort and money's been put into the ANZ One Plus program. I think ever since it was announced, the numbers around it have been grey, to say the least. And it's been years and years and years before anything's happened. And it's now getting rolled out. I think it's also fair to say that any sort of cost blowout in the One Plus program will hurt the bottom line. And likewise, any benefits which they thought they were getting, which don't happen, will hurt the bottom line. So
can I make a prediction here?
That's a key project for Nuno to manage. Yes, go ahead. Make a prediction.
My prediction is that within about 6 months, Nuno's going to go, you know what, we need to scrap this whole thing because the future of banking is all about AI. And you haven't integrated AI into this entire system. It needs to be completely rebuilt around an AI back-end framework. So then I'll scrap the whole thing and start again.
Yeah, that's door number one. It often happens with large IT projects because when they take too long to be built internally, a vendor builds it externally and will sell you, and software as a service to replace it at a very cheap price or whatever.
Or the software paradigms change dramatically within 10 years, and customer expectations, which is the big one here, change dramatically, and businesses want to derive benefits from the new technologies, and this is going to lock them in for however long. This is dead on arrival as far as I'm concerned.
And it hasn't really arrived yet. So that's the other point. It's still 2027 is when we can see the completion of the rollout. So if it goes to plan. So yeah, that's going to be an issue for Nuno. There's a couple of other issues, if you bear with me. There's been a joust between ANZ and the regulator, as there often is with banks and large companies, but there's been a couple of issues with ANZ. And APRA, the banking regulator, prudential regulator, which regulates the banks and financial institutions, has over time, but added to it more recently, imposed a $1 billion capital overlay on ANZ, which is more than what the other banks have. And to give that some context, the banks are all required to hold capital for a rainy day, for when there's a downturn like a GFC in the economy, in case there's a run on the banks. Because what the banking model is, you deposit with us and then we take that and we loan it out as mortgages and other loans. And if there's a run on the bank and you come to get you the money out of the bank, and the bank could go, well, we have to call in all these mortgages to pay you. We don't actually have the cash you put into the bank. So to try and regulate that, the banks are all required to hold what's called Tier 1 capital, and there are various tiers. ANZ has to hold more Tier 1 capital than the other banks, an extra $1 billion, because the APRA, the regulator, sees it as being slightly more risky than the other banks. And so if there's a run, they have more of a financial buffer to pay out customers who deposits into the banks. Anyway, that extra capital just sits there, and it's not earning income for the bank, or as much income as if it was loaned out as mortgages, and so it hurts their bottom line. That's occurred because over time there's been a couple of problems highlighted by the regulator. So this is from an article going back to April 4th, and it talks about some of these issues. So the Thursday before April 4th, according to this article from the AFR, ANZ released the findings of a long-running review by consultants Oliver Wyman of its markets division that uncovered bullying, substance abuse, and managers turning a blind eye to cultural failings, warning these issues could extend across the company's retail bank. while there wasn't evidence of systemic misconduct, the report found leadership shortcomings and gaps in how ANZ managed non-financial risks. The regulator went further, saying ANZ had persistent and prevalent problems with non-financial risks. The Australian Prudential Regulation Authority on Thursday said ANZ would have to hold an extra $250 million on its balance sheet to mitigate those risks, taking its total capital overlay, as it is known, to $1 billion. That compares to no capital overlay for ANZ's bigger rivals, CommBank and National Australia Bank, and a $500 million impost for Westpac. The chair, Paul O'Sullivan, has issued a mea culpa and says it is disappointing that we have not yet done enough on non-financial risk. ANZ will appoint an independent reviewer and reallocate resources to deal with its governance. Let me just go on, skip over that. Another issue, the Australian Financial Review revealed in May that the Australian Securities and Investment Commission have received a referral from the Australian Office of Financial Management, which manages multi-billion-dollar debt issuances for the federal government, about how ANZ organised the sale of $14 billion in government bonds and how they behaved. Since then, ASIC has ramped up the pressure, with its chairman, Joe Longo, telling a parliamentary committee last year the investigation had the highest priority given the seriousness of the alleged misconduct. The investigation remains ongoing and no action has been taken. That's as of April the 4th. So ASIC is also probing potential compliance failings within ANZ's retail bank, including allegations that interest on savings accounts wasn't properly accrued and that the bank charged fees on dead customers' accounts, etc., etc. So this is all, I'm reading from the Australian Financial Review article by Joyce Malarkis from the 4th of April. Some of these things are in progress. Some of these things are being resolved. But my point is that there's a lot of focus on ANZ because of regulator issues with the way the bank has been run. A lot of these things are being reviewed, and there's internal processes to fix them, etc., etc. So I'd say that, to the credit of the board and perhaps the outgoing CEO Shane Elliott, the deck's being cleared as much as possible for the new CEO. And I would say, coming from a European banking background that he has and a global banking perspective, he's used to dealing with government regulators. And I would expect that clearing the $1 billion capital overlay is a priority and perhaps a reason for why he was hired. I see you smiling there, Care to comment?
I want to go back to these non-financial risks. What did you say? Something about substance abuse issues?
Yes, in the trading room at ANZ.
So
Allegedly.
snorting coke in the trading room, is that essentially what the insinuation or allegation is here, reading between the lines?
No, I'm not going to comment on that.
Well, substance abuse, it's either alcohol or
caffeine,
or illicit drugs. Caffeine. Does that classify? APRA take issue with people drinking too much coffee at work now?
What was that Seinfeld episode? Late cups, Jerry. We have to do something. Come on.
Chrissy's been saying to me for the last week or so, are you doing coke or something? You're all like wired up. And then she figures it's the matcha. I've been drinking this new brand of ceremonial grade matcha. She's like, it's getting you wired up.
Oh, you should send your CV over to ANZ. See if you qualify.
Yeah. That's my substance abuse. Too much matcha. I was just thinking about you talking about them clearing the decks. Says Shane has cleared the decks.
Yeah. Well, hopefully. I mean, if Nuno can get in the good books of the regulators, then then they remove that $1 billion capital outlay. That's a big win for the bank.
So my question to you is this a governance red flag if they're all snorting coke in at ANZ? Should we be governance red flagging ANZ on our buy list?
Well, I haven't, and I own the stock. Potentially. Look, you could also say potentially I won't say it. The CEO's finished at almost 10-year tenure around the time that these things are being looked at. So, it may go to appeasing the regulator that they've claimed to scalp, and that Nuno can come in now and say that he's sweeping the bad eggs from ANZ, and it's a change in culture, et cetera, et cetera.
Sweeping the coke under the mat.
So look, it's still uphill for them, but it's probably a change in the right direction. Maybe it's an orange card, but yeah, new management, so hopefully new culture. And then the last thing that Nuno has to deal with is that Shane Elliott acquired Suncorp before he left, he acquired the retail banking arm of Suncorp. So
he did personally, or ANZ did?
ANZ did.
Right.
Yeah, he engineered it. So again, I'll quote from an article in the Fin. Among his achievements, Elliott streamlined the bank's Asian footprint to strengthen focus on the core business in Australia, and successfully marshalled the $4.9 billion takeover of Suncorp Bank. Speaking to his achievements, Elliott pointed to the sale of 30 mostly Asian businesses and cutting about 10,000 institutional bank customers, moves that freed up $14 billion of capital, half of which was distributed to shareholders via share buybacks, and the rest invested. Elliott said the first half had been ANZ's strongest ever for revenue at $11 billion, reflecting a step change in earnings following last year's acquisition of Suncorp Bank. Still, analysts worry that Suncorp's contribution is covering up underlying softness in the ANZ brand. We think underlying franchise results at a divisional level for the legacy ANZ business are weak, said UBS analyst John Story. So that's from the AFR May 8, an article by James Ayres about the ANZ results. But a good summary to include there, that Shane Elliott did do a good job of reversing his predecessor's expansion into Asia, and has now brought the bank largely back to the Australian shores. I did read at the time when the Suncorp acquisition was floated, some analysts were saying, well, ANZ's mortgage market share was in decline, and the mortgage market share that the banking section of Suncorp had was about the same, and so it was plugging a leak. If that's the case, that's great, but it doesn't fix the leak necessarily in the underlying business, which I think is what UBS analyst John Story was referring to there. So we need to see some evidence for the underlying blue brand, ANZ, fixing the mortgage market share leak before we can say that the problem has been solved. The other thing that Nuno will face is the headache of integrating Suncorp. It's a reasonably large acquisition. It has to be integrated into ANZ systems and processes and people. And management had already said that Suncorp synergies may not flow through until 2027. Although I think in the results they called out about 20 million per annum. I think I've got that right, but I'll cover it off in a minute. Of synergies already banked. So he's got his work cut out from him on that front as well. So that are sort of 5 things on his plate without worrying about what he wants to do to put his own stamp on the bank, including recruiting executives. So he's going to be a busy boy. But to be fair, the outgoing CEOs improved the footing of the bank by getting out of Asia, by acquiring Suncorp. I'll say it's a messy development of the OnePlus platform, but it may prove to have some benefits to the bank. And then there's the regulator issues, which Nuno should be well placed to work through, being a clean skin and having a lot of experience with regulators in Europe, and because it's a highly regulated banking system as well over there. So that's what's on his desk. Latest results. So ANZ reported cash earnings of $3.57 billion for the first half of 2025. That's up 12% half on half and broadly in line with expectations, though flat year on year. Revenue reached $11 billion, rising 5%, half on half, driven by the full 6-month contribution from Suncorp Bank, which also began to deliver early cost synergies, about $20 million realised to date, which is not the total sum of what they hoped to get. However, underlying momentum showed signs of fatigue. The group net interest margin, the NIM we've talked about before when we talk about banks, it fell 2 basis points to 1.56%. Still, anything in the 1.5s I think is reasonably healthy for a bank. And this, I'm reading from the Stock Doctor summary that Kian Trend did on the results. So he talks about the financial health perspective, and the Tier 1 ratio of 12.2 fell from 12.2% to 11.8%, but remains above the regulatory minimums, reinforcing the bank's sound capital position. Credit quality remains robust, with the individual provision loss rate stable at 4 basis points, though collective provisions increased to $145 million, up from $70 million, signalling a more cautious stance amid economic uncertainty. And that's something to focus on with banks. Generally, if they're starting to increase loss provisions, it means they think that there's a bit of instability coming, and that there'll be more, the economy's in turmoil, and there'll be more people who are either late paying their mortgages or throw their keys in and the bank takes possession of the asset. So it's not good to see that increasing, but it's not a big increase. I mean, 70 million wasn't much, and 145 million isn't much in the scheme of the amount of the billions of dollars they've got out there as listed as mortgages. But certainly it's a trend to watch. If it gets worse than that, it's not a good thing for banks. Like other major banks, earnings and dividend growth for the year is forecast to be flat to modest. Management flagged a challenging outlook shaped by global market volatility, regulatory scrutiny, including an APRA-imposed capital overlay. However, ANZ remains focused on delivering long-term value through the integration of Suncorp Bank, expansion of ANZ Plus, and continued digital investment, according to Ken at Stock Doctor. ANZ have also been buying back their shares, so that's something else to know. So that's the report on ANZ and where they're at. The QAV numbers, I'm doing the analysis at 28.66 as the stock price, which interestingly enough is 2% above consensus target. We often don't see that. So that's it's trading around or above consensus target. We give it a -1 score for that in the checklist. The IV1's only $11.46. IV2 is $21.95. So both of those are below the current price of 28.66. Stock Doctor Financial Health and Trend are strong and steady, and ANZ is what they call a star income stock. So in other words, it's a quality company. If you are investing for dividends for retirement, you should look at it. And we give it an extra 0.5 in our checklist for a star income stock, or for it being a star income stock. Stockopedia ranking, though, not as kind. Their F score is only 4 out of 9, and the quality ranking is only 44 out of 100. The value ranking was a rank of 90, which was good, but overall 69. And I think the reason for that is that Stockopedia tend to rank financial institutions lower than what Stock Doctor does. And this was actually something Stock Doctor used to do for a long time in its early days. It wouldn't rank banks because they don't display the same financial mechanisms of industrial companies. And if I look at the operating cash flow for a bank, it's meant to be the difference between the rate it pays on deposits less what it pays gets in for mortgages. In broad terms, there's obviously other things in there too, but that's the big movers of operating cash flow for a bank. But it is lumpy because if the bank issued a bond placement, that could have been for billions and billions of dollars, or if there was a lag in either mortgage interest rates changing compared to deposit rates changing, that could be a big impact on operating cash flow. So if you look at the bank's operating cash flows year to year or half on half, they can be very lumpy. But at the moment, ANZ is awash with operating cash flow. So we like it. They should put that cash flow to good use. It's a large bank with very experienced management, so we should see that operating cash flow deployed well. But I do highlight that banks come on and off our stock list in different ways than, say, a mining company does or a simple coffee shop does, because of lumpy cash flows. Anyway, going back to Stockopedia, I just wanted to highlight as well that even though they've ranked at 69 on their scoring out of 100, they do highlight the fact that ANZ is what is termed a James O'Shaughnessy's cornerstone value screen stock. And we've obviously spoke about O'Shaughnessy before in his book, What Works on Wall Street. And I'll quote from Stockopedia, James O'Shaughnessy's cornerstone value is a value investing strategy presented by US fund manager James O'Shaughnessy in his 1996 book, What Works on Wall Street. His extensive backtesting found that value investing works particularly well with large cap stocks with above average sales and cash flow, high levels of share liquidity, which were then sorted for the highest dividend yield. O'Shaughnessy said, generally speaking, when things are going against you, as they inevitably will, you have to stick to the underlying strategy. Only by doing so will you be around for when it comes rebounding back. He found that this value strategy produced an annual compound return of 15% between 54 and 96, compared to 8.3% for the S&P 500 index. O'Shaughnessy has continued to conduct detailed analysis of Standard & Poor's CompuStat database to identify the most effective investing strategies. So O'Shaughnessy likes the stock like ANZ. We like it. It's on the QAV buy list. One of the reasons why we both like it is the dividend yield is high. It's 5.79%, so it doesn't quite meet our threshold for scoring, which is the average retail mortgage rate, but it's getting up there. It's getting pretty close. PE is 12.8 times, so not the highest or the lowest in the last 3 years, so it doesn't score for that. PropCAF, however, is only 1.48 times, and that drives the high position on the buy list. And I spoke about operating cash flows in banks before. But PropCAF at 1.48 times is very, very good, very, very low. Net equity per share is $24.34, and plus 30% is $31.65, so it's higher than the stock price, so we can buy it for book plus 30%. Earnings per share growth is forecast at only being 2%, so we can't buy it for growth over PE. There's obviously no owner founder. This company's almost 200 years old. Equity is almost consistently increasing, but not quite, so we can't score it for that. So all in all, quality score is 7.5 out of 15 or 50%, so not a great quality score, but the PropCAF drives it to a QAV score of 0.34, which brings it onto the buy list since the last results, and very high up the buy list as well, and a large ADT stock, obviously. So that's ANZ.
Thank you, TK. I'm just looking at their 10-year chart, and I want to ask you about this. Like, the share price has basically been relatively stable for 10 years. If I go back 10 years ago, it was trading at $31. It's currently trading at $29. It's gone up as high as 32. And if I leave COVID out of it, that sort of 2020 period, actually, it was back to $28 by March 2021. It's sort of hovered around the $28 mark. Sometimes 27, sometimes 29, 30, but for 10 years, it's just hovered around 28, 29, 30. Not a great investment, unless you bought it smack bang at the start of COVID. It's gone nowhere for 10 years. It just seems to hover around the same zone, goes up a little bit, comes back a little bit. Like, if you look at a chart like that, yeah, it's scoring well on our buy list, but historically it's done nothing for the last 10 years. What are the chances that in the next 10 years it's going to break out of that band of $27 to $30?
Well, who knows? But I don't have a problem holding it myself. The dividend yield is going to recompense you even if the share price is flat. it's yielding on a grossed up basis 7%. But that aside, I don't see any of the banks as a buy forever stock. It'll trade through its banking. So banks tend to go in cycles, like a lot of companies do, and it'll trade through its cycle. It's come onto our buy list now. It won't stay there forever, and I expect next half operating cash may not be as strong as this half, which means it'll drop off the buy list, and then we'll trade it using our trend lines and bank dividends along the way.
Okay. Assuming you weren't in a situation where there was a limited number of things that you could buy because of your ADT requirements.
Mm-hmm.
If you had an option between buying ANZ and something else that didn't trade within a very defined band over 10 years, would you look at the other option?
Yeah. I would always try and buy from the top down. So ANZ is very high up on the buy list. So depends what the other option is, I guess. But I don't have a problem buying ANZ. It's one part of the portfolio. It's a high yielding part of the portfolio. And like I said, I think there's some, I don't want to make a prediction. I think there's some chance that there's some tailwinds behind ANZ. Interest rates cutting this year will help. If the new CEO can befriend the regulators and get the $1 billion reduced or removed from the capital, that'll help. Capital overlay, that'll help. If the acquisition at Suncorp goes well, that will help, et cetera, et cetera. So
they just need to invite the regulators to a party in the trading room.
Yeah.
That
was the problem. That was the problem. The APRA happened to be the APRA auditor visit day to the ANZ trading. Would you like some coffee?
No, the regulator didn't get invited. That was the problem. He heard about it.
I think he did get invited. That was the problem. He went, oh my God, this is what's going on. This is like Wall Street from the 1980s.
Yeah, 1985. Yeah. All right. Thank you, TK. That's ANZ. Thank you, TK. Have a good week, everyone.
Yeah. Thanks, Cam. Happy ASX.